What's up, you guys? It's Paul here from the 9 to 5 Investors Club channel here. In yesterday's video, I talked to you about how I'm trading specifically to spreads or Iron Condors around elections because of the volatility. But I got a lot of questions within my Discord group asking me to explain how to trade credit and debit spreads because a lot of people are pretty new to options trading. Now, even though I made some videos a long time ago, I thought I'd just refresh people's memories on how to trade spreads so that if you're completely new, this can help you out, okay? So I'll start with what a put credit spread is. So in a put credit spread, what you're actually trying to do is you're expecting the stock to stay above a certain level, okay? So there are two ways you can bet on a stock to stay above a certain level. You could either just buy calls, or you can trade put credit spreads because calls can potentially lose value during volatile times like we are seeing right now, and it could potentially expire either worthless or at a lower value than where you bought it at, okay? And that's where something like a put credit spread comes into the picture. So the way I come up with put credit spreads is I do some technical analysis on the stock. In this case, I have SPY, which is SPDR's S&P 500 ETF. And so just based on where it's trading at currently, you have a 50-day moving average, which is on 339, and a 200-day moving average about 312.50. And I see that you have several support lines as the stock kept falling since the correction in September, as well as what we saw in October. And based on that, I estimated that the 200-day moving average should be a very strong support. Even this support here at 322.78, which is where SPY corrected to down in September, could be a potential support. But just in for the sake of safety, let's say I went all the way down to the 200-day moving average. What I would do is I would first sell the 312.50 put, and to cover it as part of the spread, I would buy the 310 put, okay? So in this case, for 10 of those put credit spreads, I got an average credit of $50, or for 10 of them, a total credit of $500, okay? Now, the way put credit spreads work is as long as SPY stays above 312.50, since these puts would be out of the money by expiration, they would both expire worthless, and I would get to keep the initial credit, okay? Now, in order to actually place these trades on Robinhood, here's how you would do it. First, you go here to trade options, choose the expiration date, which is November 6th in this case. On the top, select put. And what I typically do is I start with the put that I want to sell because that's the level at which I'm expecting SPY to stay above, okay? So what I would do is I would sell the 312.50 put first. On top, go to buy, and I would buy the 310 put, and it'll show me right here that it'll give me a credit of $30 per put credit spread, okay? You hit continue. Let's say you want 10 of them like I did. That'll give you a credit of $310. You would hit review order. And you will see here that there's actually a collateral of $2,500. And the reason it says that is because the maximum loss you could see on this is if SPY falls all the way below $310, and then the value of the spread would actually be worth $250 because that's the difference between these strike prices, okay? So what would happen is if it falls below 310, you would have to pay $250 per spread to close this, and that's the total collateral you're going to have because for 10 spreads, that's 250 times 10, which is $2,500, okay? So if you don't have this kind of collateral sitting around in cash in your brokerage, then you will not be able to trade 10 put credit spreads. Maybe you could do just one if you have $250, for example, and you'll only get a credit of $30 to $31, okay? That's exactly how put credit spreads work. Now, in case it looks like this collateral or the risk is too much compared to how much credit you're actually getting, the reason for that is because you're exchanging lower credit for lower risk, okay? If you want to go with a higher credit, for example, to minimize your potential losses, what you could potentially do is, let's say instead of the 200-day moving average at 312.50, you decided, okay, this is a pretty strong support. I think SPY will stay about 322.50. What you could do is you could scroll up here, and you would sell the 322.50 put, and simultaneously buy, say, the 320 put, and now you get a credit of $61 instead of just $30. But since the difference in strike prices is still $250, your collateral is still going to be $2,500. Okay. So it's just similar to the previous example. The collateral is still $2,500, but instead of a credit of just $310, now you're getting $620, which is twice the credit that you got. But since it's a lot closer to where SPY is trading right now, if SPY starts crashing again because of elections and everything, and it goes below 322.50 or below 320, then you're putting yourself at a higher risk, okay? So you're getting a higher reward, but at a higher risk. The reason I went lower is for a lower risk, but also a lower reward, okay? That's how you trade put credit spreads. Now, another way to take advantage of spreads is through call credit spreads, okay? In a call credit spread, you're actually bearish on the stock. You're expecting the stock to stay below the call that you sold. Now, in this case, say SPY was at an all-time high of 358, and because of all the uncertainty in the market, I'm pretty sure that SPY is not going to go back to all-time highs anytime soon. So what I did here was I bought the 360 call and I sold the 358 call, okay? The call that I sold is the all-time highs, which I'm expecting the stock to stay below by expiration. Now, considering SPY is only at 331, I really don't think it'll reach all the way to 358 in the next couple of days. And so I got 9 of these call credit spreads for an average cost of 23, or a total credit of $207. And it looks like they're going to pretty much expire worthless, and I'll get to keep the full credit, okay? In terms of how to actually place the order, go to view all options here. Again, go to November 6th. Scroll all the way up to the call that you want to sell. Click on sell up top. You select the 358 call first. Click on buy. Then click the 360 call. And now in this case, it says credit is only $1 because these calls are so far out of the money, okay? So when you're in a bear market, when the stock is actually falling, you would get a higher credit from put credit spreads because the puts have a higher premium compared to the calls. So as you can see here, these calls are only worth $6 and $7. The more in the money you get, the more valuable they are. But again, these are riskier the closer you get to the current price, even though you're getting a higher credit. Okay, so these are two things that I want you to remember. Now here's a separate example for Alibaba that I placed just today. When you combine a call credit spread and a put credit spread, a combination of that is called an Iron Condor. Okay, so in this case, as you can see, I bought the 335 call and sold the 332.50 call, which is a call credit spread, and simultaneously I bought the 285 call and sold the 287.50 put. I meant 285 put and sold the 287.50 put, so which is a put credit spread. So a combination of all four is called an Iron Condor. Okay, so I got a credit of $415 here for it, and as long as Alibaba stays between the short put and the short call, which is 287.50 and 332.50, I'll get to keep the full credit. Okay, and that's how Iron Condors work. Iron Condors can give you a higher credit for the same collateral because you're combining the credit that you get from both the call credit and the put credit spreads for the same collateral. Okay, so again, to how to trade Iron Condors, again, go to the expiration date, which is November 6th here. Let's say you start with the call credit spread. You would sell the 332.50 call, which you're expecting it to stay below. Simultaneously, you buy the 335 call. See, the credit is 46 for now. And then you switch over to the put. And let's say you sold the 287.50 put here. Simultaneously, you're buying the 285 put. And now your total credit is $86 instead of just 46. Okay. Let's say you wanted to sell 10 of those Iron Condors, which is $860. Your collateral is still $2,500 because that's the difference between the strike prices. But the credit is so much higher than you got with SPY, which is $860 in this case. And so this was a pretty attractive trade for me, which is why I recommended it to my group as well on Discord. And so I got only 5 of them, not 10, because I didn't want to risk $2,500. And so I got a credit of $415 here. And they do have the earnings coming out on November 5th. So there's a good chance I will sell out of it before that, just so that Alibaba wouldn't spike 5 to 10% and either go above the short call or below the short put, whichever it is. I need it to stay within this range. So I'll probably sell out of it before earnings come out on November 5th. But I wanted to show you this example because just to show you how to place an Iron Condor and how it compares with call credit spread and put credit spreads. Okay, so I hope that it helped you guys a lot. Please be sure to smash that like button if you did. Do leave a comment below if you have any questions, and be sure to join Discord so you get live trade alerts like this, guys. It's been growing really fast. I'm really excited about it. And be sure to subscribe if you haven't already and hit that notification bell. Okay, thanks again for watching, and until next time.